Hi guys, welcome back to another lovely trading video. It's going to be a quick one, but it's going to be how to find stops when you're trading standard deviation. And shout out to Jay Been Dreaming for asking this question and giving me the idea for the video. So if you want to go and subscribe to him, you can. But yeah, thanks for the recommendation anyway, and I hope this helps you. So I'm going to do it on this stock that popped up on Friday, because this one went absolutely bonkers. I mean, it went, I think at some point, what were we? We were up, what, 300%? And obviously, if you were shorting this stock, you wouldn't have been having a fun time. Okay, that didn't work great, but let me check doing that. So yeah, we were up, 228% on the day. I mean, if you were shorting that somewhere down here, obviously, you would have had to stop out, otherwise your account would have just been destroyed. And so if we go on here and actually look at the resistance, we'll plot them so we could have seen where we would have been looking to short. So we would have been looking to short this deviation, and we'll just do it. We'll just put it on the green ones because it is quite a low price stock, and I don't usually touch this low. So I only really, if it's under $3, I don't tend to, or let's say 2.5, I don't tend to stop trade them unless they're coming into the green deviation. But it's a great example in this one because of how crazy this stock went. So we'll start down here and look, if we went to short this stock, we literally would have shorted the beginning of this move. So let's say we're in with 1,000 shares here, and we were looking to add in our next 1,000 at $2.84 at the last deviation we had on the chart. We would have now been in with 2,000 shares, with the stock going up at a high at this point alone, up over 60% just in this move. So that's quite a big move. But so now you need to find out where you'll be stopping out. So obviously you should only be in with maybe 5 to 6% of your account at this second short. So again, I'd be looking to short the next move at maybe a 3. So I would add into the short again at 3. So let's say now you're in with 9% of your account. Then after that, and it hasn't pulled back, I would then be slowing down shorts. That's one thing I would say if you're doing this standard deviation strategy, is slow down your shorts when you get to a stock moving this crazy. Just because it could move quite a bit, and you need to get your average up if you're looking to get out this trade without a massive loss. Unless you just sell right away, but most of the time it will come down. This is just one of the extreme stocks where it doesn't. However, you can get out of these without destroying your account. So you've added in at 3. If you're in with this kind of size, obviously you need to slow down your shorts because you can't just keep shorting forever. So then again, I'd be now looking to short at 350. So 350, where's 350 on here? Okay, so we would have shorted again here. So our average is probably around like 325, 320 or so. So our average, let's just put this over here. Our average is, let's say, 320. And we've added our last one at 350, and our next short position would be at 4. At this candle, we didn't get up to 4, so we wouldn't have looked to short. However, we have had our pullback, which on momentum like this is now where we would have taken our loss. So we're in with so say 9 to 12% of our account right now, and our average is down here, and we're looking to sell when we're coming into that 9 EMA. However, obviously if you've got big size and you want to get out, it doesn't always tap the EMA. As you can see in this case, it didn't actually touch it. So in this kind of case, you do want to just scale out as it's falling down. So we added into our short here, it fell down. I mean, at the lowest it fell down at 325, which as well, you would have seen me say in many videos, you got whole dollars, half dollars, and 25 cents and 75 cents are support and resistance lines, because that's where people look to take profits or buy in. So I would always look, especially if your average is 20, I would be looking to sell the majority of your position anyway at 325. We might not got filled, but not to worry. Because what you should have been doing on this, and how you should be looking to take your losses, is just scale out your position. So as you'll see in a lot of my trades, if you look on my Instagram or my recaps, on the when I'm doing my recaps, you got the interactive brokers here, and you can see I may be green on all tickers, but I've got some trades within that ticker where I've taken losses. That's because if I'm in with a bigger size than usual, or more, not that I'm comfortable with, but where I just want to reduce my risk even if it means taking a loss, I will sell stock on the way down for a loss, but just in smaller sizes. So let's say we're in with 4,000 shares, let's say. Our average is 320. I'd be looking to sell 1,000 shares at 330. So where did we fill? So we added to our short at 350. So I'd be looking to maybe get rid of 500 shares coming into 340, 500 shares coming into 35, 500 shares coming into 30, 500 shares coming into 25, and then I would ideally want to be getting the risk around the break even into the 9 EMA. However, in this case, obviously we didn't come down to that 20, we didn't come down to that 9 EMA. The candle closed green, so we should only be in, right now with maybe half of a position. So let's say we're in with 2,000 shares. I would then just sell the rest of the position as soon as we get a green candle, which in this case, luckily it didn't move anything too crazy, but I would have just closed out my position at the $3.48 mark as soon as the candle closed, and because that's just showing us that it may not pull back to this 9 EMA, which it didn't end up doing right now. And we don't want to be, you could always add into the short again. Now you've reduced your size, but the reason you got out of the trade is because it wasn't working. So why will it change anytime soon? You don't want to be taking that risk on a stock that it's not working with your strategy. So that's how I look to get out personally, is scale out of it for losses. The losses will get smaller as you're scaling out, because obviously it's not as far away from your break even. But yeah, usually, most of the time, it will break down to the 9. In a case like this, in a rare case when it does happen, you just have to take a bigger loss, and you just sell on that green candle, just get out of your whole position, which in this case would have saved you quite a big move. I mean, it went up to 432, probably got halted. Oh, it didn't even get halted. Kind of surprising, but sometimes like this it will get halted, especially if it's got halted and going up, it will most likely go higher. And yeah, you just don't want to be short in those kind of stocks. However, you're kind of lucky in these kind of crazy ones like XTNT. If you're using most brokers, these stocks won't be available to short. Which I actually tried to short this one on Friday, but just couldn't get any shares. Which, after, I was annoyed at the time, but after I was pretty happy because I probably would have lost money on the trade. But so yeah, I mean, in a quick summary, yeah, that's how you're looking to take your losses. Is you average your price up as much as you can, as much as you feel comfortable doing, but then you just look to sell it on the decline. And yeah, if we're getting it close to that 9 EMA, I mean, let's see on a percentage version how far we are. I mean, yeah, we're only, actually no, we're still 5%, so still crazy amount to be away from it. But it doesn't matter how, because the market doesn't have to be rational, as you know, if you're trading. You just want to take these losses as small as possible. So coming into it, yeah, you just take your loss, scale out of it as it's coming down. If it doesn't touch that 9 EMA where you want to be selling your whole position, you just sell it on the next green candle. And so sometimes as well, I said it can come back to 9 EMA. Sometimes it may knock you in profit, which is great. But if your average, if your average was, let's say, here. Sorry. Let's say, I don't even know. Yeah, let's say your average is here, comes into 9 EMA. You still just sell at the 9 EMA. If your average is ever below the 9 EMA, that's a concern, and that's when you just should get out of the position as soon as it hits the 9 EMA. Just to reduce any further risk. I mean, sometimes it may fall down, and if you stayed in the trade, you would have made money, but you just don't want to be taking that risk, especially when trading momentum, like stocks I trade, just because they can do crazy moves. I mean, if that's where your break even was and you didn't sell until you went break even, that went up 44%. You just don't want to be in that. Take those small $50, $100 losses instead of risking thousands. It's just not worth it. So I hope that helped. If you've got any more questions, let me know in the comments and I will get back to any. So that's it for the video. Peace.